Picture this. While you were popping champagne and counting down to midnight, a seismic shift occurred in the global silver market. Something so significant that it's already causing dealer prices to explode 30 to 50% above paper prices in just 24 hours. Something that will catch most investors completely off guard until it's far too late to act. Right now, at this very moment on January 1st, 2026, industrial manufacturers across the United States and Europe are staring at their computer screens in disbelief. The emails flooding their inboxes aren't warnings. They aren't delays. They're cancellations. Hard, final cancellations. Contracts that have been the backbone of their supply chains for years, gone. Orders confirmed just weeks ago with signed purchase agreements, denied. And every single cancellation notice contains the exact same explanation. Chinese government export restrictions effective immediately. No exceptions. Let me be crystal clear about what makes this moment fundamentally different from every supply shock you've witnessed in your lifetime. This isn't a shipping container stuck in a canal. This isn't a labor strike that gets resolved after negotiations. This isn't a temporary bottleneck caused by COVID or logistics chaos that works itself out over a few months. This is a deliberate, calculated, strategic move by the entity that controls between 60 and 70% of the entire world's silver refining capacity. And on January 1st, 2026, they flipped the switch from open for business to closed indefinitely. Think about that for a second. Not 10% of supply, not 20%. Between 60 and 70% of global refining capacity just went dark for Western buyers. Here's the critical distinction most people miss, and it's essential you understand this. When I say China controls 60 to 70% of global silver refining, I'm not talking about mining. Mining and refining are completely different choke points in the supply chain. Yes, silver is mined all over the world. Australia mines it. Mexico mines it. Peru mines it. The United States mines it. But here's what matters. Mining ore and having usable refined silver ready for industrial applications are two entirely separate things. That raw ore, that concentrate coming out of mines worldwide, has to go somewhere to be refined into the actual bars, granules, and high-purity products that electronics manufacturers, solar panel producers, and automotive suppliers actually need. And for the past 2 decades, that somewhere has overwhelmingly been China. Why did this happen? Because Chinese refiners systematically built massive capacity, developed world-class efficiency, and offered cost structures so competitive that it became economically irrational for miners anywhere in the world not to ship their concentrate to China for processing. So when we talk about a Chinese export ban on refined silver, we're not talking about China simply hoarding its own domestic silver. We're talking about something far more powerful. China processing the world's silver, including ore mined in Mexico, Peru, Australia, and the United States, and then deciding who gets access to the finished product. That's not just market control. That's strategic leverage over the entire global supply chain. And at midnight Beijing time on January 1st, 2026, China pulled that lever in a way that most Western analysts genuinely believed they never would. The game just changed. And most players don't even know they're already losing. Don't get caught off guard by the next market-shaking event. Subscribe now to stay ahead of developments that could impact your investments. Hit that subscribe button and turn on notifications so you never miss critical updates. The next major move is coming. Make sure you see it first. Let me paint you a picture that will make the reality of this situation absolutely clear. Imagine you're a silver miner in Peru. You've got high-grade ore coming out of the ground. You're sitting on valuable metal. But here's the problem. What you're pulling out of that mine isn't usable silver. It's ore. It's concentrate. It's raw material that's completely worthless to an electronics manufacturer or solar panel producer. That ore needs to be refined. It needs to be processed into 99.9% pure silver bars, or granules, or whatever form the end customer requires. And that's where the entire global silver market has a massive, glaring vulnerability that almost nobody outside the industry understands. You see, the world has plenty of silver mines. What the world doesn't have is nearly enough refining capacity outside of China. For the past 20 years, while Western nations were busy financializing their economies and outsourcing manufacturing, China was playing a completely different game. They were systematically building refining infrastructure. Massive, state-of-the-art facilities with economies of scale that made them unbeatable on cost. Chinese refiners didn't just build capacity, they built dominance. They offered processing fees so competitive that miners from Australia, Mexico, Peru, Canada, and even the United States found it cheaper to ship their concentrate halfway around the world to China than to refine it domestically. Think about how insane that is. American mining companies were literally shipping American silver ore to China to be refined, then buying it back as finished product. Why? Because the economics made sense. Chinese refiners were that much more efficient, that much cheaper, that much better at scale. And year after year, decade after decade, the world's silver supply chain became more and more dependent on Chinese refining. Not because China had all the silver in the ground, they don't, but because they had the infrastructure to process everyone else's silver. This is why the current situation is so catastrophically different from a typical supply disruption. If there was a mining strike in Peru, other mines could ramp up production. If there was a logistics problem in shipping, it would eventually resolve. But when the refining bottleneck gets cut off, there's no quick workaround. You can't just spin up a new refinery overnight. So when we talk about China controlling 60 to 70% of global silver refining capacity, here's what that actually means in practice. A mining company in Mexico digs silver ore out of the ground. That ore gets shipped to China. Chinese refiners process it into pure silver bars. Those bars then get sold to manufacturers worldwide, including back to buyers in Mexico, the United States, and Europe. China isn't just refining Chinese silver. They're refining the world's silver. And on January 1st, 2026, they decided to stop sending the refined product back to the West. This isn't China cutting off their own domestic supply to hurt themselves. This is China processing everyone's silver and then keeping the finished product. They're still getting the ore, they're still running their refineries, they're still producing refined silver. They're just not exporting it anymore. That's leverage. That's the kind of strategic control over a critical supply chain that can break entire industries overnight. And here's the truly terrifying part. This didn't happen by accident. This didn't happen because of a labor dispute or a technical malfunction or a natural disaster. This happened because the Chinese government looked at the global silver market, recognized that they held the ultimate choke point, and decided to exercise that power. At midnight on January 1st, 2026, Beijing time, that decision became operational reality. The export licenses got activated, the restrictions went into force, and the global silver supply chain, a supply chain that the entire Western industrial economy depends on, just got severed. The miners can still mine. The ore still exists. But without access to refining, that ore might as well be sitting at the bottom of the ocean. It's useless. And China just locked the door to the only refinery that matters. Here's where the story gets really interesting, because this didn't come out of nowhere. The Chinese government actually telegraphed this move 3 months in advance, and almost everyone in the Western financial world completely missed what was about to happen. Back in October 2025, the Chinese Ministry of Commerce published new export licensing requirements for refined silver. The announcement was public, it was official. The effective date was clearly stated, January 1st, 2026. But the reaction from Western analysts ranged from dismissive to outright skeptical. Why? Because the requirements seemed so extreme, so deliberately impossible to meet, that most people assumed China was bluffing. Surely, they thought, this was just negotiating posture, political theater, a way to extract concessions from the West on some other trade issue. Let me show you exactly why everyone thought this was unenforceable. The requirements were brutal. First, to even qualify for an export license, a refiner must produce a minimum of 80 metric tons of refined silver annually. That's approximately 2.57 million ounces. Sounds reasonable until you realize that this single requirement instantly disqualifies roughly 60% of all Chinese silver refiners. The majority of operations are smaller, regional facilities producing 40, 50, 60 tons per year. They got cut out immediately. Second, refiners must maintain established credit lines of at least $30 million US dollars. Not revenue, not assets, active credit lines. This eliminated another huge chunk of refiners whose business models operate on consignment or who don't maintain massive credit facilities because they've never needed them. But here's the real kicker, the part that made everyone think this was all for show. Even if a refiner somehow meets both thresholds, even if they clear the 80-ton production requirement and the $30 million credit requirement, even if they successfully obtain the export license, they still can't just export silver. Every single shipment requires separate government approval, not a blanket permission, not an annual quota. Shipment by shipment review by bureaucrats in Beijing who have complete discretion to approve or deny for any reason they choose, or no reason at all. When this policy was announced in October, the consensus reaction in Western markets was, they'll never actually enforce this. Why would China want to destroy a profitable export industry? Why would Chinese refiners cooperate with losing their Western customers? Why would Beijing risk the economic blowback of cutting off a major revenue stream? Analysts predicted grace periods. They predicted exemptions for existing contracts. They predicted that China would grant waivers to friendly companies or strategically important buyers. They predicted workarounds, loopholes, and backdoor channels that would allow business to continue roughly as usual. Some traders even positioned their portfolios based on the assumption that this was negotiating theater, that China would use the threat of enforcement to extract concessions from the US or Europe, then quietly back down before actually implementing the restrictions. There were detailed reports from consulting firms explaining why strict enforcement was economically irrational for China, op-eds from trade experts arguing that China wouldn't shoot itself in the foot, reassurances from industry insiders who had connections in Beijing saying not to worry, that reasonable accommodations would be made. Even the silver mining companies that would be directly affected by this policy weren't panicking. They had relationships with their Chinese refining partners going back decades. Surely those relationships would matter. Surely there would be exceptions for long-standing commercial partnerships. The Western market consensus was clear. China was saber-rattling. When push came to shove, economic reality would prevail. The export restrictions would either be watered down, delayed, or selectively enforced with enough flexibility to keep supply chains functioning. And then January 1st, 2026 arrived. No grace period, no exemptions, no flexibility, no exceptions. The policy went into effect exactly as written, and what happened next shattered every assumption the Western market had made. The bluff that everyone thought China was making? It wasn't a bluff, it was a promise, and Beijing just kept that promise with brutal, systematic precision. On January 1st, 2026, someone decided to do what financial analysts should have done months ago, actually pick up the phone and call Chinese silver refiners directly, not to read press releases, not to analyze policy documents, but to ask the simple, straightforward question that matters most. Can you export refined silver to buyers in the United States or Europe right now? 30 refiners were contacted, different sizes, different provinces, different specializations, from small family operations to massive state-owned enterprises. The geographic spread covered every major silver refining region in China. Out of those 30 refiners, 28 said no. That's a 93% denial rate. But that number alone, as shocking as it is, doesn't capture the full story. What truly matters is how they're saying no. These aren't vague excuses. These aren't, we're experiencing temporary delays or check back with us next week brush-offs. These are precise, detailed, legally grounded explanations that reference specific policy requirements, exact numerical thresholds, and direct communications from government ministries. The refiners aren't confused. They're not waiting for clarification. They know exactly what the policy says, they know exactly where they stand, and they know with absolute certainty that they cannot legally export to Western buyers. Let me break down the three categories of responses because the patterns reveal just how thoroughly this export ban has been implemented. Category 1, the disqualified majority. 18 refiners gave essentially identical responses. We do not qualify for an export license under the new requirements. These were predominantly smaller and medium-sized operations, but the category also included some larger facilities whose production just barely falls short of the 80-ton threshold. And when you talk to these refiners, what's striking is the specificity. A refiner in Hunan province that's been operating continuously for 18 years explained their situation with painful clarity. We produced 62 tons last year. The minimum requirement is 80 tons. We are not eligible. We can sell domestically within China, but export is prohibited by government policy effective January 1st. 62 tons, just 18 tons short. After 18 years in business, doesn't matter, they're out. Another refiner in Jiangxi province stated flatly, "Our credit line is $12 million, Sarge. The requirement is $30 million. We applied for the license in November. We were denied." $12 million in credit. For most businesses, that's substantial. For this policy, it's not even half of what's required. Application denied. End of discussion. Then there's the larger operation in Guangdong province, a facility that actually produces over 100 tons annually, well above the 80-ton threshold. They should qualify, right? Wrong. They explained that while they meet the production requirement, they don't meet the credit requirement because their entire financial structure operates on consignment for mining companies. They don't maintain large credit lines in their own name because their business model never required it. The ministry determined they don't qualify. They're appealing, but for now, export is forbidden. What's absolutely chilling about these responses is that every single refiner knows the exact numbers. 80 metric tons, $30 million, January 1st. These aren't rough estimates or approximations. They're quoting policy language verbatim because they've studied it, they've tried to comply with it, and they've been told definitively that they don't make the cut. Category 2. The licensed but restricted 8 refiners said they do have export licenses. These are the elite operations, the largest, most established facilities that cleared both the production and credit thresholds. Finally, some good news, right? Not even close. Having a license doesn't mean they can actually export. Remember that third requirement? Every shipment requires separate government approval, and according to multiple licensed refiners, that approval process is a nightmare. One large state-owned enterprise explained it this way: "The license doesn't mean automatic export. Each shipment requires separate approval. The ministry reviews and decides. The process usually takes 1 month, sometimes longer, and the ministry can deny for any reason, including prioritization of domestic demand. 1 month minimum, per shipment, with no guarantee of approval." Another major refiner that has historically been one of China's largest silver exporters was even more direct. "The new system is designed to give the government control over every export transaction. We technically have permission to export, but in practice, every sale must be approved by officials in Beijing who are prioritizing Chinese industrial buyers. We've already had 2 requests denied in December for European buyers. The explanation was that domestic demand is the priority. We estimate less than 20% probability of approval for new Western buyers." Let that sink in. Even the refiners who jumped through every hoop, who met every requirement, who obtained official government licenses, they still can't reliably serve Western customers. An American company that needs silver in January cannot wait 6 to 8 weeks for approval that has a 1 in 5 chance of success. That's not a supply chain, that's a blockade with paperwork. Now here's where this stops being an abstract policy discussion and becomes a full-blown crisis with real companies, real products, and real consequences. Because while analysts were still debating whether China would actually enforce these restrictions, Western industrial buyers started receiving emails that should terrify anyone who understands how fragile global supply chains really are. These aren't warnings. These aren't requests for renegotiation. These are termination notices. Hard stops. Contracts that have been the backbone of operations for years, gone in a single email. Let me walk you through 3 specific cases that have been confirmed in the past 48 hours because the details matter. Case 1. The electronics manufacturer. An electronics manufacturer had a standing quarterly purchase agreement with a Guangdong refiner for 180,000 ounces of silver. This wasn't a new relationship. They'd been doing business together for years. The arrangement was routine, predictable, reliable. On December 27th, they submitted their standard Q1 2026 order. Everything was normal. Everything was confirmed. Then January 1st hit. They received an email that was polite, professional, and absolutely devastating. Due to new Chinese government export licensing requirements effective January 1st, our facility does not meet the minimum production capacity threshold of 80 metric tons annually. Your order is canceled. We recommend seeking alternative suppliers outside of China. Canceled. Not delayed, not under review. Canceled. This company immediately contacted 3 other Chinese refiners they'd worked with as backup suppliers. All 3 sent nearly identical responses. Every single backup option gone. Now they're scrambling to source from US dealers. And here's the punchline that should wake everyone up. The delivery times they're being quoted are 18 to 24 weeks. That's not January delivery. That's not February. They're looking at May or June if they're lucky. An electronics manufacturer that needs silver to keep production lines running can't wait 6 months. They've got weeks of inventory, maybe a couple months if they ration carefully. After that, production stops. Workers get laid off. Contracts with their own customers get breached. Case 2. The solar panel producer. This one's even worse. A solar panel producer had a 10-year relationship with a specialized refiner in Jiangxi province, a decade of reliable partnership, an annual contract for 2.4 million ounces of high-purity, solar-grade silver. On December 30th, literally 2 days before the new year, they received official notice that the refiner's export license application had been denied. The reason? Their facility's annual production capacity of 62 metric tons doesn't meet the 80-ton minimum. Contract terminated. Effective immediately, after 10 years. This solar company has 6 months of inventory in stock. That sounds like a decent buffer until you realize what happens when that inventory runs out. Their production lines don't slow down. They stop completely. No silver means no solar panels. No solar panels means no revenue. No revenue means bankruptcy. They've already contacted Australian and Canadian refiners trying to find replacement supply. Guess what? Everything is contracted through 2027. Every ounce of production capacity is already spoken for. There's no available supply to buy. Their only option now? Reduce their 2026 panel production by 60 to 70%, cut manufacturing by more than half, lay off workers, break contracts with customers, watch their business implode because a bureaucrat in Beijing decided their Chinese supplier didn't meet an arbitrary threshold. Case 3. The automotive component supplier. This case shows that even having a licensed refiner doesn't save you. An automotive component supplier had secured a relationship with one of the larger Chinese refiners that actually obtained an export license. They thought they were safe. On December 28th, they submitted a request for 450,000 ounces for February delivery. Standard industrial order. Nothing unusual. January 1st arrives, request denied, no explanation provided, no appeal process, no negotiation. The refiner told them privately what the government wouldn't say officially. Approvals are being prioritized for Chinese domestic manufacturers and strategic partners. Foreign buyers are at the bottom of the priority list. Bottom of the priority list. Translation: you're not getting silver. Ever. This automotive supplier is now discovering that every alternative source they contact is either sold out or back-ordered for months. The global supply of available refined silver has effectively disappeared. These aren't hypothetical scenarios crafted for dramatic effect. These are real purchase orders being canceled, real contracts being terminated, real supply chains breaking in real time. Right now, today. And here's what makes this absolutely catastrophic. This is just the beginning. These are the first cancellations from the first 48 hours. There are hundreds, possibly thousands more companies that relied on Chinese silver who just haven't received their termination notices yet. The dominoes are falling, and most people still don't even know the game has started. Let's cut through the noise and talk numbers, because the mathematics of this crisis are brutally simple and absolutely terrifying. China refines between 600 and 700 million ounces of silver annually. Not all of that was being exported, but an estimated 350 to 400 million ounces per year was flowing to Western markets. That's the supply that just vanished on January 1st. So here's the trillion-dollar question. Can that be replaced? The answer is no, and the math proves it. Global primary silver mine production, 250 million ounces per year. But 70% of all silver comes as a byproduct of copper, lead, and zinc mining, already contracted to existing smelters. The actual uncontracted primary silver available, maybe 120 to 150 million ounces worldwide, COMEX registered vaults 42 million ounces available for immediate delivery. London Metal Exchange 900 million ounces total, but the vast majority is locked in the SLV ETF or custody accounts. Commercially available to industrial buyers, approximately 50 to 100 million ounces. U.S. dealer inventory, 20 to 30 million ounces. That's down from normal levels of 150 to 200 million due to the buying surge over the past 6 months. Add it all up, 150 million from mines, 42 million from COMEX, 75 million from London, 25 million from dealers. Total replacement supply available, roughly 290 million ounces maximum. Western buyers just lost 400 million ounces of annual supply. They can replace maybe 290 million. That leaves a structural deficit of 110 million ounces per year minimum. And that shortfall isn't going to materialize gradually over 12 months. It's hitting right now in January and February, as every industrial buyer realizes simultaneously they're all competing for the same tiny pool of non-Chinese supply. The shortage is real, the math doesn't lie, and there's no way out. While COMEX was closed for the New Year's holiday, while the paper price sat frozen at Tuesday's close of 70 centavos 20, something extraordinary was happening in the physical silver market. Because the physical market never sleeps, and on January 1st, dealers started moving aggressively. Multiple major U.S. precious metals dealers were contacted that evening with one simple question: are you aware of the Chinese export ban, and have you adjusted prices? The responses were stunning. One dealer explained, "We're absolutely aware. We're adjusting prices upward immediately. If Chinese supplies cut off, replacement costs just increased 30 to 40%. They moved American Silver Eagles from $108 to $112 up to $118 to $122 instantly. Another dealer had already raised prices to $115 to $120. If 400 million ounces per year is being removed from global supply, there's no way prices stay where they were. We'd rather raise now and have inventory to sell than keep prices low, sell out immediately, and have nothing for customers next week." A third dealer said they're considering $125 and above. "If there's institutional panic buying when traders return Friday, we need to make sure we're not caught selling inventory at prices we can't replace." Here's what's critical. These dealers aren't waiting to see if the ban gets enforced. They're not assuming it's temporary. They're treating it as final and repricing for a world where 400 million ounces just vanished. The prices they're moving to, 115 to 128, are 50 to 65% above the COMEX spot price of $77.20. That's not a premium anymore. That's a different price. That's the physical market and paper market operating in completely separate realities. The paper market closed at $77.20 on Tuesday before the ban took effect. The physical market spent New Year's Day repricing for a shortage. When COMEX opens Friday, that gap is going to close violently. So what happens when COMEX opens Friday, January 2nd? What happens when institutional traders come back from their New Year's break, read the news, see dealer prices at $120, and realize they're already late to the biggest supply shock in silver market history? Here's the scenario. Institutional buyers at major banks and hedge funds return to their desks Friday morning. They immediately see reports of Chinese refiners denying Western buyers. They see contract cancellations. They see physical dealer prices at $120 while COMEX closed at 70 centavos $20. And if those traders have clients who need silver, industrial companies calling frantically saying, "We can't get metal from China anymore, you need to source it now," they're going to panic buy. The expectation? A massive gap up at the open. COMEX silver probably opens somewhere in the $85–92 range, a jump of $8 to $15 in the first seconds of trading. Why? Because large buy orders hitting a market with thin liquidity on the first trading day of the year creates violent price gaps. And this isn't normal first-day back trading. This is emergency buying by companies that literally cannot operate without silver. After that initial gap, continued upward pressure throughout the day and into next week as more buyers realize the shortage is real and that price must rise to ration the limited available supply. By the end of January, COMEX silver trading in the $110–130 range wouldn't be surprising, exactly where the physical market is already pricing it today. If that convergence happens, if the paper price rallies to meet the physical price, that validates everyone who's been buying and holding physical silver. Those weren't premiums. That was the real price all along. The spot price was the artificial price. And reality is about to force a correction. Let me be absolutely clear about something. This is not hype. This is not speculation. This is not fear-mongering designed to manipulate markets. This is documented supply chain disruption with measurable impacts and quantifiable shortfalls. Here are the facts. The Chinese silver export ban is real and being enforced systematically across the entire refining industry. 93% of refiners contacted said they cannot export to Western buyers. 18 don't qualify for licenses because they fail the 80-ton production or $30 million credit requirements. 8 have licenses but face 4 to 6 week approval processes with less than 20% success rates. 2 are waiting for clarification and not accepting orders. 3 Western industrial buyers have confirmed receiving cancellation notices from Chinese suppliers, citing the January 1st export ban. Supply contracts terminated. Orders canceled. Companies scrambling to find alternatives facing 18 24-week delivery delays. 6 U.S. bullion dealers raised prices on January 1st in direct response to the export ban. Prices jumped from $108.112 to $115.128. Dealers are treating the ban as permanent and repricing for a world where 400 million ounces annually just disappeared. The supply-demand math is brutal and undeniable. 400 million ounces of annual exports stopped. Maximum replacement supply from non-Chinese sources, approximately 290 million ounces. Structural deficit, 110 million ounces per year minimum. The physical market already reflects this reality. Dealer prices at $115, $128, while paper sits at 70.20. That's a 50 to 65% gap between physical and paper. When COMEX opens Friday and institutional buyers return to work, that gap closes. The repricing is happening right now while most of the market celebrates New Year's. This is January 1st, 2026, the day the supply chain broke, and nothing will ever be the same. Before I close, let me say something critical. This is not financial advice. I'm not telling you what to do with your money. I'm presenting documented information about a developing crisis in the silver market. You must do your own research, consult financial professionals if appropriate, and make decisions based on your own circumstances and risk tolerance. But here's what I'm telling you. Something historically significant happened on January 1st, 2026. The Chinese silver export ban took effect. The enforcement is real, the denials are documented, and the market is repricing in real time. Markets move on information asymmetry. The people who act on new information before the crowd does are the ones who benefit from price movements. Right now, on the evening of January 1st, most market participants don't know this is happening. They're celebrating. They're on vacation. They're not monitoring dealer prices or calling refiners. But by Friday morning, everyone will know. By next week, it will be headline news across financial media. The question is, are you positioned for what comes next? The export ban is real. The shortfall is measurable. The repricing has already begun in the physical market. And when the paper market catches up, when COMEX traders realize 400 million ounces just vanished, the price movement is going to be violent and fast. You can't build a new refinery in a week. You can't create new mine production in a month. The supply that disappeared is gone for the foreseeable future, and price must rise to reflect that new reality. This is January 1st, 2026. The day everything changed, and by Friday, the whole world will know it. The only question left is, will you be ready? Join us daily for breaking market analysis and real-time updates on the silver crisis. Every day, we cut through the noise to bring you actionable intelligence on commodity markets, supply chain disruptions, and price movements. Subscribe and check back daily, because in this market, yesterday's news is already too late.